In 1984, a parent who put $5,000 into Microsoft stock at its IPO and never told their child about it would have given that child, by the time they were in their 40s, something worth over $3 million. In 1994, a parent who bought a piece of land outside a city that nobody thought was going to grow and held it untouched in a family trust for 30 years, handed their children an asset worth 10 to 20 times what they paid. In 2009, the year Bitcoin launched at fractions of a cent, a parent who bought $1,000 of Bitcoin and put it in cold storage with instructions not to touch it until their child turned 30 would have handed that child, if they followed the instructions, something worth hundreds of millions of dollars by the peak of the most recent cycle. Nobody did that because nobody knew, because the thing that produces generational wealth almost never looks like generational wealth. When you are buying it, it looks like a speculative technology. It looks like undeveloped land outside a growing city. It looks like a volatile digital asset trading at $1.10 with a fear index in the 20s. So XRP is trading at approximately $1.10 today, July 11th, 2026. XLM is at approximately 20 cents. HBAR is at approximately 7 to 8 cents. And the question this video is asking is not whether these assets are going up next week or next month. The question is, what happens to a position in these three assets if you treat it the way the parents who got lucky with Microsoft or Bitcoin treated their positions, not as a trade, but as a transfer, something you buy, structure, legally to minimize tax drag, put in a form your children can inherit without a nightmare, and do not touch for 15 to 20 years, while the financial infrastructure underneath it compounds. That question has a specific, honest, calculable answer, and a specific structure for making it work, and a historical precedent that makes the answer less speculative than most people would expect. That is what this video is. Before we dive back into today's topic, if you love actionable strategies that actually multiply your wealth, make sure to hit that subscribe button. Right now, I want to pull back the curtain and share the exact system I've used to grow my initial $20,000 deposit into over $600,000 in just under 2 years. It's a platform called GCRIG. I've been with GCRIG since the early days when fiat was the only option, but they've recently leveled up in a big way. They now fully support cryptocurrency. This means you can seamlessly fund your account using assets like Bitcoin or XRP, and more importantly, withdraw your profits in crypto for lightning-fast payouts. Here is why this system is a game changer. GCRIG is an absolute powerhouse for automated arbitrage trading. You don't need to be an expert or stare at charts all day. Once you make your deposit, the system's algorithm instantly scans global markets for the most profitable arbitrage routes. It executes the trades entirely on autopilot. You just sit back, relax, and collect your contracted profits as soon as your term expires. To keep things completely transparent, here is how the platform sustains itself. GCRIG charges a tiny 1% withdrawal fee on the profits realized, and any excess profit generated above your contract goes to XLM. It is a true win-win ecosystem that incentivizes the platform to perform at its best for you. If you are ready to put your money to work and want to join my exclusive GCRIG arbitrage trading team, take action right now. Drop a comment down below on this video or shoot me a direct message on Telegram at XRP Hobart. All right, let's get back to the topic. Let me start with the historical comparison, because I think it is the most important framing and the one that makes the generational case feel like history rather than hope. Every major infrastructure transition in the last 2 centuries has produced a specific window, a period of years, sometimes a decade, where the assets that would eventually be worth fortunes were available at prices that reflected uncertainty rather than inevitability. The window for buying Manhattan real estate for next to nothing was the 1800s. The window for buying railroad stock before the transcontinental expansion was the 1850s. The window for buying Standard Oil before Rockefeller's consolidation of the petroleum industry was the 1870s. The window for buying AT&T before telephone infrastructure became universal was the early 1900s. So, the window for buying equity in companies building internet infrastructure was the late 1990s and early 2000s, after the dot-com crash cleared out the speculative noise and left the real infrastructure builders at discounted prices. Every single one of those windows had the same feeling at the time: uncertain, volatile, surrounded by skeptics with reasonable arguments, preceded by a period where some version of the same thing had already crashed dramatically, making the remaining skepticism feel well-founded. And in every single case, the people who bought the infrastructure, not the speculation layered on top of it, the actual infrastructure, and held it across a generation, produced wealth that their children and grandchildren are still living on. The cross-border settlement infrastructure being built on XRP, the tokenized security settlement layer being built on Stellar, the enterprise finality infrastructure being built on Hedera. These are the railroad tracks and telephone lines and internet backbones of a financial system that is transitioning from analog to digital rails. The window for buying them at uncertainty price rather than inevitability price levels is not infinite. It is the period between now, while regulatory frameworks are still clarifying, while the DTCC integration is in early production, while institutional adoption is real but not yet dominant, and the moment when the infrastructure becomes undeniable to the broader market, that window closes. These windows always close. The question the generational strategy is asking is whether you put something into these assets before it closes in a form that your children benefit from, rather than making the decision solely based on your own short-term price tolerance. Now, the honest data, because the generational argument has to be grounded in what these assets actually are right now, including the headwinds, rather than in the best possible version of the story. XRP at $110, $69 billion market cap, $62.47 billion circulating supply, 9 consecutive weeks of ETF inflows, $40 billion in daily trading volume on some days, regulatory clarity from the Torres ruling, Flutterwave equity stake, expanding payment corridors into 34 African countries. The Clarity Act progressing through the U.S. legislature with XRP as one of the most directly benefiting assets. These are the genuine strengths. The honest risk is that XRP's previous all-time high of $3.84 came and went in January 2025, and the post-death correction has brought it back to around $1.10. A parent building a 20-year position in XRP is betting that the next cycle peak exceeds $3.84, that the institutional payment corridor adoption generates sustained demand, and that the asset maintains its position as one of the primary cross-currency settlement assets in the financial system's transition. That is a reasonable bet. It is not a certainty. XLM at 20 cents, $6 billion market cap, $30 billion, circulating permanently fixed $3 billion in real-world assets on the network. Clearstream institutional custody added July 8th, DTCC production integration running, Protocol 27 deployed this week with 300% volume surge. The genuine risk here is that XLM's path to its previous all-time market cap of $19 billion, roughly a 3 times move from today, requires the DTCC integration to generate the open market XLM demand that the reserve requirement thesis projects. That data is not yet confirmed. The October 2026 expansion phase is the first real test. A parent building a 20-year position in XLM is betting that the DTCC integration generates visible on-chain XLM demand over the next 2 to 3 years, and that by the time their child is an adult, the Stellar network is recognized as the settlement layer for a multi-trillion-dollar tokenized securities market. The fixed supply of 30 billion tokens makes the arithmetic compelling if the demand arrives. The uncertainty is whether and how fast it arrives. HBAR at $0.078, $3.1 billion market cap, around $44 billion circulating, $104.31 million in cumulative net inflows to the Canary ETF enterprise deployments, including Google, IBM, and Lloyd's Banking Group. HashSphere integration for insurance industry property data completed in May. Hedera's private ledger for enterprise use cases expanding alongside the public network. And here's where the honest treatment is most important. HBR has fallen approximately 83% from its most recent local high. Technical analysts are flagging a critical long-term support zone between $0.042 and $0.058. There's a supply overhang of approximately $3.97 billion HBAR slated for ecosystem release. The Canary ETF inflows are consistent but modest compared to XRPs. Bithumb halted HBR deposits and withdrawals July 8th for a routine network upgrade. A neutral event, but a reminder that the asset operates in real operational conditions with real institutional infrastructure requirements. I'm telling you all of that because the generational strategy is not about picking the assets that feel best to hold. It's about picking the assets whose underlying infrastructure case is genuinely strong enough to survive the headwinds over a 15 to 20 year horizon. And HBR's case on that dimension is genuinely strong, even with the honest risks acknowledged. The hashgraph consensus mechanism providing absolute finality at enterprise throughput is not a feature that can be replicated by a protocol upgrade on a competing chain. Hedera's enterprise relationships with Google, IBM, FedEx, and Deutsche Bank, among others, represent a decade of institutional trust building that doesn't get reversed by a bear market. The RWA settlement thesis, where HBAR's fee mechanism creates utility-driven buy pressure as tokenized asset volume grows at scale, is structurally sound, even if the timeline is slower than the most optimistic projections. The supply overhang, specifically the $3.97 billion HBR slated for ecosystem release, is worth addressing directly in the context of a 20-year holding period rather than a trading period. Supply overhangs matter enormously on a 1 to 3 year price chart because the additional supply hitting the market creates persistent selling pressure that caps rallies. On a 20-year horizon, the supply overhang is largely irrelevant because the full distribution of ecosystem tokens will have completed years before. Your child inherits the position. The HBAR that is being released today to fund ecosystem initiatives is the HBAR being used to build the enterprise partnerships, developer tools, and infrastructure integrations that drive the network's long-term utility value. The supply that feels like a headwind on this year's price chart is the fuel for the adoption that justifies the 20-year thesis. That perspective does not eliminate the short-term risk. If you need the money in 2 years, HBR's supply overhang is a genuine concern. If your timeline is your children's adulthood, it resolves itself. Now, the plant a tree moment. The best time to plant a tree was 20 years ago. The second best time is now, and I want to make that concrete for the 3 assets with specific 20-year math. Because 20 years from now, your children are either going to have something or they are not going to have something. Whether they have something depends on whether you plant the tree today. $1,000 is the planning figure because $5,000 is an amount that a meaningful percentage of people watching this video could actually commit, not their entire savings. Not a bet the house position. $5,000 split across 3 assets in a generational structure, allocation by the same logic as the retirement portfolio framework. The most established asset gets the largest share. The highest upside assets get proportionally more. 3,000 to XRP, 1,000 to XLM, 1,000 to HBAR. $3,000 into XRP at $1.10 buys approximately 2,727 XRP. $1,000 into XLM at 20 cents buys 5,000 XLM. $1,000 into HBR at 8 cents buys 12,500 HBR. Now the 20-year scenario's conservative. XRP reaches $10, a market cap of approximately $625 billion, below Ethereum's recent peak. XLM reaches $1.50, requiring a $95 billion market cap supported by DTCC integration at scale. HBR reaches 50 cents, roughly returning to its all-time high price on a somewhat larger circulating supply. 2,727 XRP at $10 is $27,270. 5,000 XLM at $1.50 is $7,500. 12,500 HBR at $1 is $6,250. Total conservative scenario value $41,020 from a $5,000 investment and 820% return in 20 years. In 20 years, what does $41,000 buy your child in 20 years? In today's purchasing power, adjusting for even modest inflation, it is the equivalent of roughly $25,000 to $30,000 today. A meaningful contribution toward a first home deposit, a year's university tuition at many institutions. A meaningful nest egg that starts their adult financial life further ahead than it would otherwise begin. Base case, XRP reaches $15, a market cap of approximately $938 billion within the range that Bitcoin has achieved. XLM reaches $3, requiring a $190 billion market cap, supported by DTCC, full deployment, and the tokenized securities market, reaching several hundred billion in total value. HBAR reaches $1, returning to a market cap of approximately $44 billion if the current circulating supply, driven by 10 years of enterprise transaction volume growth and creating meaningful fee demand. $2,727 XRP at $15 is $40,905. $5,000 XLM at $3 is $15,000. $12,500 HBAR at $1 is $12,500. Total base case value $68,405 from $5,000 invested, a 1,268% return. What does $68,000 buy your child in 20 years? In today's purchasing power, roughly $40,000 to $50,000, a deposit on a first home in most markets. Several years of postgraduate study, funded, a business started. The gap between a financial life that begins from zero and a financial life that begins from a meaningful base, that gap is what generational wealth actually means for most people. Not hundreds of millions. The difference between starting at zero and starting with something exceptional scenario, XRP reaches $25. A market cap of approximately $1.56 trillion. XLM reaches $5, requiring a $150 billion market cap. Achievable if Stellar holds double-digit percentage share of a multi-trillion-dollar tokenized securities market. HBR reaches $2, requiring a market cap of approximately $88 billion, justified if enterprise transaction volume creates the kind of utility-driven HBR demand that the fee mechanism projects at scale. 2,727 XRP at $25 is $68,175. 5,000 XLM at $5 is $25,000. 12,500 HBAR at $2 is $25,000. Total exceptional scenario value, $118,175 from $5,000 invested, a 2,263% return. What does $118,000 buy your child in 20 years? In today's purchasing power, approximately $60,000 to $80,000. A substantial home deposit in most markets, a fully funded emergency fund plus investment account to begin their adult financial life, the kind of financial foundation that most people spend their entire career trying to build while simultaneously paying rent and managing debt. None of those scenarios require these assets to become the most valuable things in the world. They require the infrastructure they represent to achieve institutional adoption at a scale that the current deployment activity suggests is plausible on a 10 to 20-year timeline. XRP becoming one of the primary cross-currency settlement assets for a multi-trillion-dollar global payment market. XLM becoming the settlement layer for a tokenized securities market in the hundreds of billions. HBAR becoming the enterprise finality infrastructure for a tokenized real-world asset ecosystem worth trillions globally. These are not moonshot projections. They are the logical endpoints of what is being built right now. If the building succeeds, now the structure, because putting crypto in a drawer and hoping your children find it someday is not a generational strategy, it is a lottery ticket. A real generational strategy requires legal structure that ensures the assets pass efficiently, avoids unnecessary tax events, and gives your children actual access rather than a legal headache. The simplest approach in the United States for most people is a revocable living trust. You create the trust. You are the trustee during your lifetime. You hold the crypto assets in the trust's name. Or more practically, you maintain the wallet and name the trust as beneficiary in your estate planning documents. The trust specifies that the assets pass to your named beneficiaries, your children, either immediately on your death or at a specified age. Assets held in trust at the time of death avoid probate, which means faster transfer, lower administrative cost, and less public exposure of what you are leaving. The trust can also specify conditions. Your children receive the assets at age 25 rather than immediately, for example, which adds a layer of protection against them selling too early during a market panic. The tax treatment is equally important. In the United States, crypto assets held to death receive a step-up in cost basis, meaning your children inherit the assets at their fair market value on the date of death, not at your original purchase price. If you bought HBAR at 8 cents and it's worth $2 when your estate is settled, your children's cost basis is $2 per HBAR, not 8 cents. They owe capital gains tax only on appreciation after the date of inheritance, not on the gains accumulated during your lifetime. That step up is one of the most valuable tax provisions available for generational wealth transfer of appreciating assets, and crypto assets benefit from it the same way real estate and equities do. The hardware wallet solution is the practical companion to the trust structure, not an exchange account. A hardware wallet, a ledger, or a trezor held in your physical possession with the seed phrase stored in a sealed envelope, with your estate documents accessible to your executor or trustee. The trust documents specify that the executor has authority to access and transfer the digital assets. The seed phrase documentation makes that access possible. Without that documentation, your children cannot access the assets regardless of what the trust says. The documentation is as important as the legal structure. What your parents could have bought you in 2009 with $1,000 in. Bitcoin put into cold storage, structured into a simple trust, never touched for 16 years, is today worth something in the range of several $1 million at peak cycle valuations. Not because Bitcoin turned out to be the world's reserve currency, and because your parents would have bought Bitcoin when it was priced for uncertainty rather than for inevitability in the year the infrastructure launched, and held it long enough for the infrastructure to become undeniable. XRP at $1.10, XLM at 20 cents, HBAR at 8 cents. These are the prices of uncertainty in July 2026. The infrastructure is real. The institutional adoption is in progress. The window for buying at uncertainty prices rather than inevitability prices is open, whether it stays open for another year or another 3 years, or closes faster than anyone expects. That is genuinely uncertain. What is not uncertain is that the infrastructure being built on these 3 networks is real, that the institutions deploying on them are among the most significant in the global financial system, and that 20 years is long enough for the inevitable to become uncertain, undeniable. Plant the tree, build the structure, and let your children ask you 20 years from now what you were thinking when you bought it at these prices. The answer is the same one every person who bought Microsoft in '84 or Manhattan real estate in the '50s or railroad stock in the 1870s would give. I saw the infrastructure being built, and I believed it was going to matter. Drop in the comments, do you currently have a legal structure for your crypto holdings that would allow your children to inherit them without a legal nightmare? Because most people do not. And that conversation, how to actually pass these assets properly, is the one that separates a generational strategy from a good intention. So if this shifted the frame from what XRP, XLM, and HBAR are worth this week to what they could represent for the people who come after you, hit the like button. That longer frame is harder to hold and deserves more reach than it typically gets. Subscribe if you want the analysis that thinks in decades rather than cycles. And share this with anyone in your life who has children and holds these assets without a plan for how those assets eventually pass to the next generation. The best time to plant this tree was years ago. The second best time is today. Have a great day. If you enjoyed this video, don't forget to like, subscribe to the channel, and be sure to join my free Telegram community with the link on my channel where I post my daily crypto experience and arbitrage opportunities you can't get anywhere else. This is XRP Hobart signing off.